we'll do is we'll ask you to put your questions into the meeting chat function, and you can either do that to the whole group or just to Megan Matuszewski, who's online here with us. I think y'all can see Megan. And Megan will capture those chat questions, and then during the moderation portion of our webinar this morning, we will go to those questions then, and we'll get everybody out of here before 8:30 so you can get on to the rest of your day. We will have another BreakFAST with BMO event later in July, and that one we're planning in person as well. So don't worry, you'll get a breakfast at some point here with us, just not today. But again, thanks everybody. Just want to also thank BMO Bank for sponsoring our Critical Topics webinars. We couldn't do this without them. They've been a great partner, and as everybody knows, in Janesville-Rock County, they've got a really nice presence in our community, and can't thank them enough for being with us on this and on this journey. We will have different critical topics each month this year. Next month is pretty exciting already. We're ready to launch that very soon, right, Megan? We're going to be making that announcement and sending that out, and the date, and save that on your calendars when you see that coming out. All right, so I will go ahead and Megan, I think you may have to start the recording if you could. Hit the record button, and then I'll start introductions with Michael. So
yep, it is started.
Great, thank you. So Michael Gregory is a Deputy Chief Economist and Head of U.S. Economics for BMO Capital Markets. He manages the team that's responsible for forecasting and analyzing the North American economy and financial markets. So what a treat this is to have somebody with that huge outlook with us here virtually in Janesville today. Michael began his career in economics with Royal Bank of Canada in Montreal in the mid-1980s, and before moving to Toronto to work for RBC's Foreign Exchange and Money Market Research Group. He eventually moved further along in the yield curve and across the border, joining the fixed income strategy group at Lehman Brothers in New York City in the mid-1990s. Returning to Canada at the end of 2001, Michael headed up the financial services analysis team at Bank of Montreal and focused on regulatory and industry restructuring issues before shifting to BMO Capital Markets economics in 2004. He moved to Chicago in late 2013, providing research support for the U.S. and Canadian fixed income business and working with the global fixed income strategy team before returning to Toronto just last year. And Toronto's such a great city. Michael is a graduate of Concordia University in Montreal and the University of Western Ontario in London. Michael did doctoral studies at Fordham University in New York City, and he holds a chartered financial analyst designation. So many accolades there, Michael, and a storied career in financial markets, and we can't wait to hear what you have to say and give us some hope and excitement about the future, right? So I'm going to turn it over to you. Thank you so much for being here today.
Well, thank you very much, Angela, and good morning, everyone. Now, I'm going to share my screen now. As a sign of the times where we're doing things in person more these days, my virtual edge may be a little bit rusty, so bear with me as I share my screen here, and just bear with me a second. Where is that window? Here we go. Wherever it is here, and we're going to make this one a little bit bigger. All right. Do we have a full screen there? Angela, are we okay there?
Yes, you're great.
Perfect, great. Okay, so listen, I'm going to start this party, get going. And all right, so the title of my talk today, and Angela and team asked me to speak for about 20 minutes, so we have plenty of time left over for Q&A, is from here to price stability. Obviously, the inflation has been like the #1 issue affecting the U.S. economy for the past year, or well over the past year now. And getting it back to price stability is job #1 for the Fed. Of course, price stability is something close around 2% inflation. So it begs the question, where are we in this fight? The Fed has been very aggressive in raising interest rates. Where are we on that inflation fight? Well, starting off, think about it. It was this time last year we were seeing inflation, headline inflation for the CPI peaking above 9%. That's the most we've seen in more than 4 decades, and it's been literally cut in half, more than half, since then. And so that's good news. We're at 4%, not quite 2%, but at least that's a lot closer to 2 than 9 is. So why did inflation sort of come down? Well, a couple of reasons for that. The biggest one, of course, is that resource prices have fallen. Think about it. It was a year ago we were paying more than $5 a gallon for gasoline. Now we're kind of in the mid 3% range. So that has pulled down headline inflation big time. Another important factor that's pulled down inflation is that global supply chains have become unsnarled. Now, recall when we reopened our economy, demand just came roaring back, but at the same time, domestic and global supply chains were still impacted by the pandemic, and it's caused this huge imbalance in the domestic and global economy where demand was greater than supply. Recall when we used to go into stores and those shelves were a little bare? Remember when we had to pay above invoice for a new vehicle? Now we're not doing it. We're not too many sales, but at least we're not paying above invoice anymore. So slowly but surely, those goods, the supply is caught up to demand. It's the Federal Reserve Bank of New York has an index called the Global Supply Chain Pressure Index, which they measure things like backlogs of orders, excess inventories that in the global economy, not only for the U.S. but for all the major trading nations in the world. And that index right now, in the latest month, was at its lowest level in some 25 years. This gives you a sense how much we've dealt with the supply side on the good side of the economy. However, when you look at sort of core inflation, strip out food and energy, and you see that things are a little more stubborn on that front. And they're stubborn because of the services side of the economy. Remember, when you think about global economy, we're trading on goods. We don't really trade a lot in services. Services are homegrown. And it's largely the cost of that is driven by wage pressures. So what we're beginning to see is some stickiness on the core inflation front, largely driven by stubborn or wage growth. Now, on the good side of the economy, another reason why we've had this dampening of inflation is because the global economy itself has slowed down quite considerably. And of course, that has helped bring demand and supply into better balance. Dampen demand a little bit, keep that supply growing, and slowly but surely you'll deal with those inflation pressures. Now, we expect the global economy to grow 2.7% this year, which doesn't seem too bad on the surface, but for the global economy, that's actually a pretty weak result. In fact, that's apart from the pandemic in 2020 and the global financial crisis in 2009. That is the weakest growth we've had in the global economy for some 20 years. Now, when you kind of look at sort of, and I've listed here the 12 largest economies in the world, and near the top of the league table, as you would normally expect to see, India and China. Well, China, as you all know, had pretty onerous restrictions up until the end of last year with respect to COVID, and they've sort of reopened their economy, but they have a little bit of growing pains as they come out of their economy. They've started to stimulate. They've just cut interest rates. Here we go. The Fed has been raising interest rates. Most countries in the world have been raising interest rates, but China has been cutting interest rates to try to stimulate their economy as they reopened from the pandemic-related restrictions. India, as typical now, the top of the league table is at the bottom. We have Russia that continuing to contract, largely because of sanctions of the West, because of their invasion of Ukraine. But everywhere else in the middle, between those two extremes, are all facing the same problem: relatively high rates of inflation, and apart from Japan, dealing with that inflation by raising interest rates. Keep in mind that inflation is a headwind from growth. It erodes purchasing power, it slows demand, and of course, on top of that slowing of demand, if you're raising interest rates, that slows it even further. And then lately, of course, we've seen the beginning of the spring of this year that in Europe with respect to Credit Suisse, but here in the U.S. with respect to sort of some key regional banks, we've seen some pressure on that side in terms of sort of tightening of credit standards because of issues. I'll be coming back to talk about that in just a second. But clearly, the big dampener we've had on global growth for the most part has been what central banks have been doing in raising interest rates. These are the most largest central banks, the G10 in the world. As you can see, everybody's been raising interest rates, save for Japan, as I mentioned before. important thing to keep in mind here is where the Fed is. Yes, the Reserve Bank of New Zealand has raised interest rates more than the Fed, but quite frankly, we think the Fed will overtake the Reserve Bank of New Zealand in terms of being one of the most aggressive of the major central banks in lifting interest rates. To put this in perspective, since the Fed began targeting interest rates in the 1980s, this is the most and the fastest they've ever lifted interest rates. Some of you will recall back in the days of Paul Volcker when we had huge swings in interest rates, that they weren't really targeting interest rates back then. They were targeting things like bank reserves and the money supply and things like that. And the interest rates became more volatile because of that. But since they began officially targeting interest rates, the most important thing they look at, this has been the most aggressive they've ever been. And it's not surprising. We also have the most serious inflation fight on our hands in some 40 years. But given how aggressively the Fed has acted, and that pushes up yields along the yield curve, and of course that then becomes a huge beacon for capital flows into the U.S. Treasury market and to the U.S. economy broadly. That has actually pushed up the value of the U.S. dollar. For some of you that are exporters out there, you know what that has meant in terms of in some of your foreign markets. And in fact, a lot of countries didn't really stimulate their economies during the pandemic like the US did, or Europe did, or Canada did, or a lot of other major countries. Countries like Brazil and Mexico, for example, stimulated their economies quite little. Nevertheless, they ended up with the same kind of inflation problem, in part because of importing it. A strong US dollar, at least initially, translated into weak currencies in many emerging markets. And therefore, since most goods are denominated in US dollars, that meant you were importing inflation as you imported the goods for consumption. So that was an important sort of a driver of inflation globally, has been a strong US dollar. Okay, so turning back to the last big issue with respect to the outlook for inflation in the United States, and it has to do on the core inflation side, largely services, where things are very sticky in terms of inflation there because of still elevated wage growth. So when you turn to the labor market, and this is something Chair Powell talks a lot about, where we still have this imbalance between demand and supply. And in fact, when you look at, so we measure demand as how many people you've actually hired plus how many people you would like to hire in terms of the job openings. Supply, of course, is just the labor force. And when you look at that imbalance, we still have an imbalance of about more than 4 million workers, where demand is outstripping supply by some 4 million. And what the Fed is trying very hard to do is to dampen that green line, dampen that demand, allowing supply slowly to catch up and hopefully bring balance of sort of between demand and supply in the labor market. Well, dampening that demand can be kind of tricky, because normally it means you have to, perhaps create some job layoffs potentially. Historically, that's what's happened in the past, and therefore create a weak enough economy so businesses not only stop hiring, but they actually maybe potentially lay some workers off. And that's really an outcome the Fed is desperately trying to avoid. Can we get inflation down? Can we get wage growth down without creating a lot of unemployment, without creating a lot of job losses? And the Fed is of the mind that maybe they can do this. And the reason is because unlike every other episode we've had before, a large part of labor demand is actually unfilled or unsatisfied. It's job openings. So in fact, if you look at where job openings are right now, we have sort of more than 10 million jobs vacant across the country. Normally we'd expect to see something around 4 or 5 a million jobs. That's more than 10 million, of course. And therefore, if we can actually just get rid of all these job openings, which, by the way, those openings are adding to the upward pressure on inflation, because that is what you're advertising, and your existing workforce see what other companies are offering for new employees, and therefore that puts a little bit of upward pressure on your own wage bill. So if you can actually reduce this demand for labor by reducing hiring or the desire for hiring, maybe we can minimize the actual net job losses. And therefore, that potentially could make this downturn in the economy quite mild by historical standards. And, a case in point, we've seen, earlier in the past year or so, that a lot of the job layoff announcements in the tech sector, for example, in the West Coast. Well, a lot of those layoffs, in fact, were positions that were not yet filled. So that's kind of interesting. So, and of course, when you see the layoffs, that acts as a little bit of a restraint on other people's wage demand. So maybe the Fed will be able to do this. But on the supply side, and that's the other side of the equation, demand remains pretty strong. But where have all the workers? Where did all the workers go in the wake of the pandemic? And in fact, when you kind of dig a little bit deeper in the fact that the labor force participation rate hasn't returned back to where it was before the pandemic, it's not at all sort of even across age cohorts. For example, prime age workers, those are those in that 25 to 54 age bracket, that participation rate has fully recovered and is above where it was before the pandemic. So we're getting workers back from that perspective. Where things are lagging are in the 55 plus, of course, the most important workers in the economy. And a lot of early retirements have affected that. And also in the sort of the 20 to 24 age bracket, that too remains down. And perhaps, because of, having to deal with the pandemic during their college years, maybe labor force engagement of those new grads is not what it was in sort of other generations. But the key thing is, though, we do have, the workers are out there, and we do have participation among those prime age workers. So to me, the major issue here, and we do have longer term issues with labor growth, and I'm sure we'll probably talk about that at some point down the road. But the fact is that it's labor demand that's so strong, and that's something the Fed knows how to fix. In the meantime, whether it is the supply side or the demand side, the net result is the same. You're ended up with elevated wage pressures. Now, wage growth, just like inflation, has started to roll over. It's not as rapid as it was over the past year. But if you were to sort of circle where all the latest observations are and to draw a line going to the origin, you'll find that we're still at elevated levels. We are still running around 4% range wage growth, and not coincidentally, we're running around 4% inflation in terms of underlying inflation trends. Wages and prices continue to remain very sticky here, and that's something the Fed is desperately trying to deal with. All right, so all of those wages are helping to fuel spending in the economy, not surprisingly. And I put this chart up here because I wanted to talk a little bit more about the inflation dynamic. Firstly, this is the spending by U.S. consumers after adjusting for inflation. So it's real outlays on goods, real outlays on services. And as you can see, if you look at the underlying trends before the pandemic, we are still not at the point where we've even recovered back to where we should be on the services side. And in other words, we call that pent-up demand still exists. It's the reason why, despite higher prices, restaurants are full, people are still going on vacations, despite the ridiculous prices you're paying for these things these days. And that gives you a sense that demand is still robust enough on a part of the economy where all the inflation is. That's an important thing to keep in mind. On the good side of the economy, yes, we had that huge surge coming out of the depths of the pandemic recession, and things have kind of skated sideways. But I would make the argument that given, there still probably is a little bit of pent-up demand for goods, even on the auto side, where a lot of folks didn't get the models they wanted, and therefore they say, fine, I'll wait another year before I buy a car. But I also wanted to point out the impact of stimulus. We had 3 rounds of economic impact payments, at first at the depth of the pandemic, and then late in the Trump administration, and very early in the Biden administration. And those economic impact payments were a little bit different than any other kind of stimulus that other countries did, where you're actually giving money directly to households to either save or spend or whatever. But the key thing to keep in mind, by the time of the 3rd round of economic impact payments, the real demand for goods in the United States was more than 20% above where it was before the pandemic. More than 20% above. To put that in perspective, we basically took about 6 years of healthy growth in the demand for cars and flat screen TVs and stuff for the house. 6 years of solid growth, and we squeezed that into 1 year. Now, when you're the largest economy on the face of the planet and you have that kind of surge in demand for things, needless to say, that just ripples through both domestic and global supply chains. So in many respects, it was really U.S. demand that caused this, inflation problem to really perpetuate not only globally, but persist domestically as long as it did. Now, of course, a lot of those payments and a lot of that saving money, that the support that was provided to households was saved, mainly because, particularly at the onset of the pandemic, you really couldn't spend it because the economy we had various degrees of lockdowns throughout the country. But nevertheless, a lot of this was actually saved. And in fact, by the time we got to the end of 2021, if you look at sort of households were normally saving about 7.5% of their income before the pandemic. And then during the pandemic, when they either got a little income support or they continued to work, which most Americans did, but didn't have the expenses like they worked, like dry cleaning a suit or whatever the case may be, or having to eat out for lunch, or couldn't just simply spend on other things they wanted to. They amassed some $2.4 trillion of funds above and beyond what they would normally be saving in for their retirements or college education or whatever the case may be. And since the end of 2021, the savings rate has fallen below where it was before the pandemic, which means that households are now drawing down on that excess reserves to the tune of about $1 trillion so far. So there's still $1.4 trillion out there to keep support spending in the face of higher prices, in the face of higher interest rates, which is a good thing from an economic perspective, but it's a frustrating thing for the Fed, because there's an old adage out there, and I'm sure you folks have heard it before, that the cure for higher prices is higher prices. Inflation erodes purchasing power, that reduces demand, and it equilibrates demand and supply. But if in the face of higher prices, particularly if you're on the sort of the higher income sort of strata of households where most of these savings reside, excess savings reside, you have the ability to keep paying higher prices for longer. Yeah, I'm paying, for an appetizer what I used to pay for an entree at the restaurant. I'm paying, full offer on all these vacation packages. Yet I can, because I have the money. And I'm going to keep doing that. And that actually causes the inflation process to persist a little bit longer. And so just sort of keep that sort of in the back of your mind. And that makes the Fed's job a little more tricky. Now, the Fed signaled earlier this month they had 2 more rate increases up its sleeve. We think they'll get 1 more in there next month in July. And then, as the economy kind of weakens off, which we're expecting, that they won't raise rates anymore. And in fact, beginning next year, next spring, we think they'll start very slowly to cut interest rates, and we'll talk about the reasons for that. But even when they're keeping rates on hold, or even maybe starting to cut them very slowly, we do think that they'll continue to be tightening from their balance sheet perspective, quantitative tightening, allowing those trillions of dollars, hundreds of billions of dollars of securities they bought to mature and kind of roll off, which of course absorbs a lot of that excess liquidity in the economy. And and that, combined with rate hikes, actually causes financial conditions broadly to be weaker when they otherwise would be. Weaker stock prices, higher mortgage rates, which of course is something many of us feel in the economy. Now, on top of these pressure on financial conditions, and I mentioned this earlier, we also have this additional headwind coming through tighter credit conditions because of the fact we just went through the second, the third, and the 4th largest bank failure in U.S. history. And now, fortunately, fortunately, a lot of the problems that these institutions had were idiosyncratic. We don't have a systemic problem in the banking sector like may have been the case during the global financial crisis. So that's a good thing. And when you kind of look what's been happening to the credit tightening among all banks, it has continued to tighten, but it was tightening anyway ahead of the problems we had this spring. So merely it just reinforced that trend. But for regional and smaller banks specifically, we could have an issue where credit will be a little more constrained than it otherwise would be, because as you know, the way that banks operate, they take in deposits, they make loans. But for a lot of the deposits, some of these institutions will have gotten in the past uninsured deposits. There'll be a little more hesitancy, perhaps, to have that flow to the same degree, and therefore perhaps less credit being provided by regional and smaller banks in the U.S. economy. They tend to supply about 30% of the credit. So that that will be noticed. I mean, some of that will be offset by the larger banks, but nevertheless, that's a potential headwind. And in particular, one sector specifically, commercial real estate. That is where regional and smaller banks punch above their weight class, supplying almost 2/3 of the credit for that sector. And that's a sector that's already feeling a bit strained because of rising office vacancy rates, because for some reason, we do things virtually a lot more than we've done them in the past. All right, so a quick example of the financial conditions, I mentioned it before, mortgage rates, at the depths of the pandemic, the Fed, cut interest rates to zero, began buying not only treasury securities to bring down longer term interest rates, bought mortgage securities on top of that to narrow the spread of mortgage securities versus treasuries. So it's a double win for how low mortgage rates got. In fact, they got under sort of 330 there for a while. These are 30-year fixed rate mortgages, which was the lowest mortgage rates have ever been in the history of the country. So a couple of years of that, needless to say, it really helped stimulate the housing market. And then, of course, as the Fed began to raise interest rates and began allowing, its holdings of treasuries and mortgage-backed securities to mature, that kind of added to the upward pressure. And we went from the lowest in history to the highest mortgage rates in a couple of decades. And we kind of settled in just below that level. And we know the impact that had on the housing market. We saw home sales, which had kind of taken off, just kind of roll over quite significantly. And basically what happened in terms of housing demand, you had sort of the two prongs, both. You had elevated home price inflation at the time, elevated mortgage rates. Those things combined together to significantly erode affordability, and therefore housing demand fell quite sharply. Interestingly, as home prices have started to stabilize, mortgage rates have started to stabilize, we've seen the housing market start to stabilize. And you can see the latest home readings, have been bouncing around, kind of drifting sideways, which is encouraging, which means, once, I think how many potential homeowners, got so, interest rates rose so quickly, the most in their lifetimes, and prices were already kind of high that people got, outpriced from the market very quickly. But the demand still stays there. So the moment we see some stability on the borrowing front, on the price front, slowly but surely, I think potential home buyers are beginning to test the waters, which is encouraging. But again, it's one of these double-edged swords, because if the most interest-sensitive sector of the economy is showing signs of stabilizing, the Fed may interpret that to mean, well, maybe overall for the whole economy, our monetary policy may not be restrictive enough, which is maybe one of the reasons why they may continue to raise interest rates. Needless to say, the weakness we've seen in the housing market has been instrumental in bringing down home price inflation. One of the reasons core inflation has been stubborn, well, the two main reasons, one is because it's the ubiquitous influence of wage growth in the services sector, which is, permeates the cost structure there. But the other one is the way we measure housing costs in the various price indices. They actually reflect market conditions with a pretty long lag. So we still have home price inflation going on, rent price inflation going on in the CPI, when we know out there in the economy, rents have stabilized, if not fallen, in many markets. Prices of homes have fallen, if not stabilized, in many markets. And it's only a matter of time before those declines we're seeing begin reflected in the CPI, which is one of the reasons why the Fed is even more focused not only on core inflation, but something called super core inflation, which looks at core, which, as you know, strips out food and energy from the headline. They further strip out goods, all goods prices, because of the improved, the goods price inflation is very, very low because of improved global supply chains. And they just look at the services side, core services, but then they strip out the housing cost. And what's left over still is about half the index, but that's purely driven by wage growth. And that has become the focus of their attention. All right, so what does it all mean for the economy? We've got some, we're looking for growth to weaken off in the second half of this year, and actually post some consecutive quarters of negative growth, back-to-back negative growth. All right, now, before we talk about what that means, one of the reasons why we're only looking for a very mild downturn historically is because the economy still has some pretty major cushions. We talked about a couple of those already. Pent-up demand for spending on services. We still have a lot of excess savings that could potentially keep consumer spending going. In fact, many businesses also have a lot of liquidity providing support for them as well. A couple of other things I really hadn't talked about. One of them is this concept of labor hoarding. Listen, many of you out there have had the hardest time attracting and retaining workers. And the moment you start to see some economic weakness, maybe in past cycles, you may have started kind of laying people off, but maybe you'll be a little more hesitant this time. maybe reduce hours a little bit so that you can keep those workers, because the moment the economy rebounds, you're going to need those same workers back, and it'll be just as hard to get them back. So this notion as the helps keep the unemployment rate from rising as much. The other issue is the fact between the infrastructure bill, which was a bipartisan act, between the CHIPS Act, which was a bipartisan act, and of course the Inflation Reduction Act and its clean energy investment parts. All of those things have added about more than $1 trillion of net new money spending in the economy in the area of sort of investment in those sectors. And that provides a powerful support for the economy. Now, we still have the headwinds. Those headwinds, of course, I mentioned before, we've got that banking system stress. We have the lagged impact of 500 basis points of rate hikes. And we have the particular issues in commercial real estate, which, could prove to be problematic. And then, of course, come this autumn, beginning September, but with the first payments made in October, we have student interest payments are resuming after being sort of postponed since the depths of the pandemic. And there's a lot of folks out there that have a lot of debt they still have to pay interest on, and that's going to be instead of spending going in on consumer items, it's going to go on servicing that debt, which of course takes some spending out of the economy. So we're looking for the economy to shrink, peak to trough in the second half of this year by 0.3%. 0.3. A typical recession, the big R, is about 2 to 3 percentage points of contraction. We basically have about a tenth of a normal downturn in the economy. In fact, as most of you know, the economy actually, GDP-wise, actually contracted in the first half of last year by 0.6%. So this is even below that. So is this a recession? That's what I'm getting to. Well, it's going to satisfy the GDP definition of that, but one of the key criteria you need to actually have a bona fide recession, which why we didn't have at the start of last year, which it could be considered for this year, is the fact we're going to get some mild job losses, okay? And that is usually what determines whether this downturn in the economy is actually a recession or not. But even if we do get job losses, we do believe they will be mild by historical standards. We are looking for the unemployment rate to rise to about 4.5%. We are currently at 3.7. We got down to 3.4 just a few months ago, which is the lowest or matches the lowest in some 70 years. That's how tight labor markets are. And quite frankly, at 4.5%, that's not far off the longer run level for the jobless rate. So we're going to get some slack in labor markets, but most of that slack is going to come by job openings disappearing. People just stop hiring. They don't start firing and laying people off. They just stop hiring. And you'll get enough of the downward pressure on wage growth to start easing the services inflation, which by the start of next year will be well into the 3% range in terms of both headline and core inflation, on a trajectory to get you down to 2% by the end of next year, which is why I think the Fed feels very comfortable about starting to cut interest rates slowly. But once we get to that 2%, I do think the Fed will start to quicken the pace of rate cuts to get us back to neutral. And by the way, neutral, folks, it ain't zero. Neutral is about 2.5%. So, think about that's where, the Fed's interest rates will eventually reside, which means longer term treasury yields around that sort of low 3% range, which means longer term mortgage rates at around the high 4s, low 5s. Okay, that is normal. And we're going to go back to normal. And with that, I think we have some time left over here for questions. So I'm just going to end my slideshow. And then
well, hang on, we might have questions on those slides, so maybe don't quite go away yet with those.
Okay,
Michael.
I won't. Are you still see the slides?
Yeah, we still see them. Yeah, so you'll be able to go back and forth if you want. Well, that was
sure. I'll do that. Yeah, we'll go back here. You bet. Okay, not a problem. Okay.
Yeah,
perfect.
For those of you that don't know, Michael's been on our virtual webinars kind of through the pandemic, and always gives a really great overview of a lot of data here. So super, he really packs it in the morning, so you can get a lot of information in these talks with Michael. So we appreciate all that. Michael, you talked a little bit about the businesses. If you just stop hiring, we're going to see some of this compression and relief. What is the likelihood that businesses are like, yeah, we're at a point where we're good, we're stable, we don't need to keep looking for workforce because looking for workforce has been a big problem for companies over the last 2 years. And coming out of the pandemic, we've seen just, record amounts of people not returning to work. And of course, we had the large retirement hitting us. So what is the likelihood of that? What are you hearing and seeing that from a trend standpoint across the nation?
Sure. Well, I mean, the first thing is demand or sales are starting to soften. You're seeing that across a lot of sectors. So that right away changes the mindset of employers to expansion to, okay, got a whole firm, we got to maybe batten down the hatches a little bit. So I think the natural reaction is to, okay, how do we can't really pass on any more price increases, first of all, because demand is starting to soften. It's easy to raise your prices when all your competitors are doing it and demand is strong and it's more than absorbing it. But when demand starts to soften, it's a lot harder to raise prices, which means you got to look inwards, if you're worried about margin compression and things like that. So all of a sudden, the amount of money you spend on looking for talent, retaining talent, all of a sudden that puts the pressure on that. So I do think businesses are going to find over the next 6 to 8 months that the conditions that had them wanting to keep looking are going to disappear, and in fact, they'll probably sit down around the board table and think very seriously. We have to cut, but we don't really want to cut. And we're starting to see signs of that already. And the way you see that is when you look at the monthly job numbers produced by the Bureau of Labor Statistics. And what you're seeing is we're still getting payroll job expansion. At the same time, hours are starting to slip, average hours worked. So that tells you that people may be deploying their workforce less efficiently for at least a little while. I mean, you can't have that situation forever. At some point, the lack of productivity and efficiency begins to weigh, and that's when you start cutting down not just the fat but to the bone, right? But for the time being, I think we are going to see businesses say, fine, I'm out. I've got my workforce. I'm more than capable of handling not only this weakened demand, but as demand begins to ramp up again, I can handle that with my current complement of workers. So I'm not going to be looking actively for the next little while.
Yeah. Okay. Great. And Mark Hutchinson just asked if we're going to make the deck available, and we will do that. Well, actually, the whole presentation is recorded, so we'll be sharing it out. And if, by the way, in the audience, if you have any questions, just a reminder to raise your hand, click the little hand that you might see at the top of your screen. Looks like Mr. Hiller just did that. So I've got some more questions for you, Michael, but since we've got a hand up, I'm gonna turn it over to Dave Hiller, who's Executive Vice President Manufacturing at Print Corporation. Dave, your question?
Hey, thank you, Angela. Good morning, Michael, and hey, thanks for great clarity this morning. My question is centered around kind of the drivers around inflation being stubborn. So you talked a little bit about that, and one of the reasons you gave was, hey, there's still some excess savings out there that could be spent, right? And that's kind of propping some things up. One of the reasons potentially, right? Mm-hmm. So my question is really around, earlier in your presentation, you talked about economic impact payments, and I think those were of a personal nature. But I think when you look at the totality of Fed spending, that timeline of economic impact payments is probably much larger, right? Yeah. And so my question to you is, does anyone have any idea of how much latent dollars are still out there from a Fed perspective? So, for example, there's a number of businesses that have still yet to receive their ERTC payments, right, which could be in the billions. Yeah. And so all of those dollars, as they continue to hit the economy, will still prop up demand. So do we have any idea how much latent Fed spending is out there?
Yeah, fair enough. What we do have is how much money was allocated to these programs, like the amounts, and some of that, as you mentioned correctly, hasn't been sort of deployed. It's been accounted for in terms of deficits and spending, but hasn't been deployed in the economy. So it's going to have some kind of a real impact. As you know, as part of the legislation to lift the debt ceiling, unspent COVID funds, which there were some, has been sort of repurposed. So there won't be any net new money coming out of that. But there still is that, but there's also a little bit of a headwind, perhaps, as slowly but surely the government is kind of looking at those folks that maybe weren't completely honorable or honest in terms of applications for the funding they needed, and so there was some element of fraud in these things. So trying to get those funds back, which of course will mean that somebody's not going to have those funds to spend. So I do think there is some funds still there, but I actually do think they pale in comparison to the hundreds of billions of dollars that are being put to work, again, already accounted for in terms of the three pieces of legislation I kind of referred to, but that are now coming through the pipe. You look at construction spending in the U.S. economy right now. Where is it hottest? In non-residential. It's just flying through the roof. Everywhere you look, someone's building a battery plant or a solar plant, or what's along those lines, or a chip manufacturer, or whatever the case may be. So that money is flowing through. So yes, there still is fiscal largesse working its way through the economy, minimizing the downturn, but at the same time, perhaps causing the inflation to be just a little more stubborn than you like. But that may be the price we have to pay for avoiding a really nasty recession.
Thanks, Michael.
Thank you.
Great.
Angela, you're on mute.
Oh, geez, here I am. Okay, so thanks.
Those are the best questions, Angela, the ones I don't
Yeah,
hear. I love those ones. They're the easiest to answer.
I've got my list of questions written down here. This is great. But I'm going to go to Mark Gregory since he's got his hand up. Mark, go ahead.
All right. Thanks, Angela.
Yeah.
Michael, again, thanks for the clarity on a lot of things. The question you had mentioned that commercial real estate could be a challenging point within the economy. Do you see that really affecting any specific geographic areas? We hear a lot about office space within some of your metro markets with people returning or choosing not to return to the office. Or I guess, how do you apply that to more of our Midwestern economies compared to, kind of nationwide?
Sure. Well, no, correct point. Where that impact will be most profound would be, of course, in the major sort of metro areas, major urban areas. The poster child for the problems, people look at San Francisco, for example, and the fact where vacancy rates are, among the lowest in the country. So yeah, that's problematic. Now, of course, these folks are still, at home, working remotely. The other area, and of course, that's not necessarily going to impact the same degree once we get out in beyond sort of get into the suburban and the ex-urban areas, where there's also office space. In some cases, office space that kind of expanded as folks wanted to be, have some office type facilities close to home, but not necessarily all the way going back downtown. And so I do think that area will probably fare a bit better, simply because the remote work will still be sort of a phenomena that we're contending with. The other area which could be a little more egalitarian across the country is on the retail side. We're going to get in a period here, despite the support from excess savings and things like that. I mean, the only way you can really slow down the U.S. economy, given 2/3 of it is consumer spending, is to slow consumer spending because you created some weakness or some in the labor market. Folks that still have excess savings go, you know what? I don't think we'll be spending that. We're going to hold on to that just in case. It'll become more precautionary savings, and therefore, I think you're going to see a less favorable outlook for sort of the retail space as well. So that could prove to be a problem as well in terms of weakness in that sector. And I think it's really just office and a little bit of retail that there's really a problem. But the one that's probably going to see some impact around the place, your strip malls that maybe not your Class A type strip malls, that kind of thing. They may they may suffer in this coming downturn.
Thank you.
Thank you.
Awesome. Hey, Michael, one of the questions I wanted to go back to is regarding your yield curve and seeing that, that's inverted. with a short-term interest rates above with short-term interest rates above long-term interest rates.
Yeah.
So does this mean we're gonna for sure head towards a recession based on that inverted yield curve, or how can we avoid that recession? Is there a softer landing that's possible?
Good. Fair enough. Let's listen. I mean, some of you that did economics in college, you know that the yield curve, the inversion of a yield curve, where again, as you correctly point out, Angela, where short-term interest rates are above long-term interest rates, has been a pretty good predictor. In fact, a pretty accurate predictor of recessions. And in fact, the latest inversions we're seeing and how much they've inverted, are all pointing towards, the weakest point in the economy being around the end of this year. Okay, so that is a pure model-driven abstract from anything. Now, when you do realize on top of that, we still have those cushions I talked about, some pent-up spending. We still have, because of the U.S. dollar, interest rates in the United States are probably lower. Longer-term interest rates are lower than they otherwise would be because of all the huge capital inflows. That maybe has caused a bit more. Fed has absolute control of the front end of the curve. They don't control the long end. So the curve may be overemphasizing just how much of an inversion is fundamentally there. Plus the cushions tell me that we're going to get a weaker economic outcomes, no question about it. But will we get a real a sort of recession? I think it's questionable. And ultimately recessions are determined by an entity called the National Bureau of Economic Research in Massachusetts, and a bunch of academic economists get together and they look at a bunch of indicators, and they dated business cycles back to the after the Civil War, and so there's a rich history of this, and the most important thing that determines whether we have a recession or not for them, our payroll employment. As long as we're producing jobs, we have an expansion. Once we stop producing jobs, then maybe we have a recession. But if it doesn't last that long, it may be just like a blip, and maybe it's not profound enough, or with history will be revised away so that they don't actually calling it a recession. So a recession is not necessary or guaranteed. But I do think a soft landing seems to be a scenario. And a soft landing to me could mean plus 0.5% growth, minus 0.5% growth. It's in that range. We're going to notice things have ground to a halt. We're going to notice things are weak, but not to the point where you go, oh my gosh, I'm going to lose my job, I'm going to lose my house. That kind of mentality will not be part of this coming downturn.
Great. I don't see any hands up, but I'm going to keep going here. So you mentioned a little bit about that saving grace and some of that spending that's going to continue to go in, which is, affecting that recession or not, right? But one of the questions I had, you showed the graph. I think if you want to go back to it, it was the saving grace. It had 7.6% spending pre-pandemic. I'm sorry, savings pre-pandemic, and that we're pretty low on saving across the nation right now, with that trend being $1 trillion down. Mm-hmm. What is the long-term effects of that on the economy when people aren't saving for their future, aren't saving for college, aren't saving for their retirements and those things? What do you see as the outcome of that when we are pretty low in savings right now?
Well, yeah, we're low in savings, but keep in mind the bar there was at 7.5%. So if we were saving at 7.5% ever since the pandemic, so the last three and a half years, how much money we would have had for retirement and college? Okay, now the excess is above that. Yes, and right, we've been drawing down that excess, but there's still an excess. Okay, that's something to sort of keep in mind, that American households have still been saving. They've still been prudent. If there's anything different than this downturn compared, say, to the one we had in 08, 09, was that household balance sheets in aggregate across the country are in good shape. Debt hasn't gotten crazy. There's not a lot of imbalances. People still have their assets and their savings. So this drawdown here is yes, it's helping to fund spending, but it's not at the expense of what you would have saved otherwise. It's something to keep in mind. This is all of an excess. But, that said, it is quite possible, faced with a downturn, and again, do this kind of thought experiment. Obviously, if you're worried about the future for the next 6-8 months or whatever the case may be, chances are your equilibrium or the kind of savings rate you'd like to have is probably higher than it was before the pandemic. Maybe it's 8.5% or 9.5%. So just kind of think of that sort of line kind of shifting up a bit, and all of a sudden, the excess you had is not excess anymore. You actually are going to roll that into your permanent savings. And so I don't think we're at the point where we're not saving enough in this country. 7.5% is an adequate amount. But the bigger issue to me is, how do we fund things like Social Security and Medicare longer term? That is the bigger thing, and somehow we have to deal with that, because that one of the reasons why people may not save as much as in other countries is because they know they've got Social Security that can provide support. They know they've got Medicare, and the thing is, though, those things aren't funded on a sustainable basis. So there's still a day of reckoning in terms of a savings rate, not for households, but maybe for the broader whole economy, given the deficits.
Great. Well, just keep saving, right? So
Yeah.
and I got another question that was sent to me. It reads, Janesville's got a thriving business sector, but our economy, we've been challenged by inflation, especially in the building sector with the loan rates. And I know if you want to bring up your other slide on that, that's probably what this is really referring to. So home loans and those interest rates, Janesville's looking to add housing at all income levels, from those that need it most to the executive housing and everybody in between. So do you see the ceiling for this interest rate hike ending anytime soon? Where do you see that coming in? I think you talked a little bit about that, but could you maybe get a bit into this interest rate increase challenge for the housing market?
Yeah, absolutely. Well, obviously the Fed has even told us they've got more rate hikes up their sleeve, and those don't translate one-to-one, say, into 10-year treasuries. And by the way, the 10-year treasury note tends to be the interest rate that tends to match most closely with 30-year fixed rate mortgages, for the simple reason that's how banks tend to hedge those portfolios. That everyone keeps their mortgages for 30 years, and 10 years seems to be sort of the average, which is why they sort of use that. So 10-year rates aren't going to rise as much, and in fact, maybe they've peaked already. The issue, though, I think for housing is the fact these rates probably are not going to go back to where they were before, obviously during the depths of the pandemic, and they're going to remain at moderate levels. Again, as I indicated before, maybe high 4% range, low 5% range, which, believe it or not, that's a very normal level of long-term borrowing costs for the U.S. economy. But there are other constraints on building side. Number one, employment in the trades. That was quite problematic. And labor issues. Truck drivers getting the goods to the job site. I mean, the building materials. In fact, despite the fact we weren't building starting record amounts of homes over the last few years, we had record amounts of homes under construction, even more than we had during the housing bubble. And the reason for that, we can start homes, but they took longer to finish, simply because you didn't have the doors, you didn't have the windows, whatever the case may be. The tradespeople were few and far between, and therefore things took longer to get done. That's still a problem, I think, going forward. So in terms of affordability for housing, it's critically important, particularly as you want to grow our workforce. And so, I mean, there's probably a role for government here in terms of providing support for affordable housing. But, there's nothing like, interest rates stable, home price inflation stable, and employment stable. All of those things, those three facets, all kind of stabilizing. I think will be an important ingredient to bringing back life to the housing markets going forward.
Wonderful. Well, great. I see us. We're just right above our ending time here. If there's any last questions, please raise your hand. We'll take one more. Not seeing any. Michael, I think this has just been a great informative talk again, and an update from you since a year ago of where we were at. Is a much different market, much different economic outlook. So we really appreciate all your updated information and where we're heading. And it's exciting to see all these charts and graphs. We will share the slides. We'll have this video recording also shared out later today once it becomes available to the audience. So we will share that. We just want to thank you again for being with us. And sorry flights were canceled and you weren't able to be here in person. We were excited to have you, and but another time.
Thank you.
Yeah. All right. Well, everybody, just to wrap up, we will have our announcement coming out soon, as soon as next week on our July BreakFAST with BMO. It will be an in-person, and our speakers are not traveling from another country or another city. So we'll be local enough with that announcement. So that one will be in person for sure. Thank you all for tuning in today. We appreciate it. Have a great day.
Thank you.